think I said this on my last call with Jay, I'd put it as high as 20 to 25% of business acquisitions struggle in the first 12 to 18 months. And struggle is a pretty loaded word, but it can range anywhere from, I thought my cash flow was amazing, I really am making just enough money to pay the bank, all the way, I have payroll Friday and I have no idea how I'm going to make it. Default is an absolute catastrophe. That is bankruptcy, liquidation, houses taken, kind of an ugly, messy situation. Colin McNulty. I'm with First Savings Bank. I'm based in St. Louis. The headquarters of the bank is in Southern Indiana, just over the border from Louisville. Generally speaking, I am a one-trick pony, SBA 7A loans. That covers the gamut of startups, franchises, real estate, business acquisitions, you name it, debt consolidation. If it's a 7A eligible deal, then we are interested in pursuing it. Deal sizes ranging from anywhere from $500,000 up to the max of $5 million. I'm going to tell you this, even though I always feel like I shouldn't. I also can do USDA loans. It's kind of a little bit of a Sasquatch for me in that I've heard about them and hear a bunch of people who've done it, but I've never actually seen it myself. But I do have one going right now, so we'll see. That's typically a more defensive product for us than offensive, meaning it's in an industry that we can't do, or there's a size variable there. But for the most part, for purpose of discussion here today, I'm an SBA 7A lender. Probably half to 3/4 of what I do tends to be real estate oriented. That could mean we did a business acquisition that included the real estate. It's an existing company that's buying a building. It's consolidating debt within a real estate loan. I'm making up these numbers. I don't know if it was actually that high or not, but the other bulk of this tends to be oriented in the business acquisition space. Sweet spot for me is probably less driven on the size of the loan and more about the goodwill and or collateral shortfall. If you're talking about buying a big distribution company where it's a $5 million loan and there's no assets, we can do it. I will candidly tell you that's not our strength, though. If you're buying a business for $800,000, that is that structure, we're going to be much more aggressive. If you're buying a $5 million business, but 3.5 to 4 of it is real estate, we're going to be more aggressive under those confines. But what I typically tell people is going to be that if I can't do it, and I'm, even how I just explained that there, I'll let you know very quickly whether it's a fit for me, and if it's not, then I will tell you, hey, here's some partners that I know of, other banks that maybe are a little more into this space. Even though we all do the same thing, we tend to gravitate towards specific niches. Generally speaking, there are certain lenders who love giant goodwill acquisitions deal and bake that into their risk model. There's others that don't do things like startups or construction, which we do. So, but generally speaking, always feel free to reach out. If I can't do it, I'm very quick to tell people that I cannot do it. Been here for 2.5 years. I spent a decade at a bank called CIBC, where I did SBA and conventional lending. So I have a little bit different flair than most of my peers around how I look at opportunities. When I spent the better part of a decade at that company, I would close on an acquisition loan, but also keep it in my portfolio and service it, which is fairly uncommon in my line of work. I would argue it's fairly inefficient too, but it was good training for me to see what happens afterwards. I've said this to Jay in the past, but I'm probably going to be more conservative than most other SBA lenders you speak with. And that's not out of the product of this industry tends to be you have a lot of people who look, because of how these SBA loans are structured, not look at the deal from the can or should I do this? It's can I get it done? Yeah. Most people in my role, and that includes me today, what I do. Yeah. We book a deal and we move on. And then it becomes a servicing person. And maybe depending on how in depth you want to be as a lender, you might even not know what happens after that. I have a pretty unique experience of seeing what does happen after loans close. I spent a better part of a decade doing that. Very low, especially when it comes to business acquisitions, what I know will be a big focus on our call today. Business acquisitions don't usually go into default. It's fairly uncommon. I think last year it was pretty high compared to normal, but it's typically kind of in the 1 to 3% range, I believe, with kind of like 2 to 2.5% being the norm. Don't quote me on those exact numbers, but it's in that ballpark. So that's a pretty low number when you think about what we're doing as lenders, or low single digits. But understand that a default is an absolute catastrophe. That is bankruptcy, liquidation, houses taken, kind of an ugly, messy situation. There's a much bigger number, and I think I said this on my last call with Jay. I'd put it as high as 20 to 25% of business acquisitions struggle in the first 12 to 18 months. And struggle is a pretty loaded word, but it can range anywhere from I thought my cash flow was amazing, I really am making just enough money to pay the bank, all the way to I have payroll Friday and I have no idea how I'm going to make it. As a lot of people I know on this team are business owners anyways, you will find those kind of struggles happen every year anyways. Whenever you own a business, you're going to have some kind of pain point every single year. The difference is in year one of buying a business, you're learning about that business and you are levered to the teeth. So you have very little runway there. So I tell people this not to scare them, but just to know that I look at things from a little bit more constructive view than just, will my bank do this? There's a lot of deals I know I can get done, I have passed on because I don't feel comfortable putting someone in that situation. As servicing these loans, I unfortunately had to go through a couple of liquidations over the course of that, decade. It's a miserable experience. Every lender should do it because it makes you not so cavalier of saying, well, the SBA allows it, I should do it. If you really read the SBA's SOP, you can get almost anything done. It's not a restrictive document in terms of they only require like 1.15 debt service coverage. That means if you had a minor blip, you're in trouble. So anyway, little backstory there. I say that again, not to put fear in your process, but just I'm going to look at things less of a yes man and more of a here's what I see wrong. Any acquisition, especially, you tend to see an entrepreneur who's very interested in buying a business, a seller who cannot wait to close, and a broker who will be paid the day it closes. No one in that party is going, well, wait a minute, should I be doing this? That's what I believe my role is to be. It's not to tell you you're the prettiest, you're the smartest, you're the greatest business owner. I'm supposed to challenge you if I'm doing my role properly. So
Nice.
anyway, that was the background, Jay, that you asked for.
No, that's great. So two things that you brought up. One is what is the sweet spot in terms of size and industry? I know you mentioned it, but what is the sweet spot in size and industry for you guys?
So I would argue our sweet spot is probably going to be kind of between people borrowing 750 to about 3 million.
Okay.
There's no magic that I just came up with. I mean, if you really want to dial into it, we go to loan committee at 2 million.
Okay.
So you can simplify that to down, 750 to 2 million, but
So
we go to loan committee all the time.
anything below 2 million, there's no loan committee.
That's correct.
Got it. Okay.
So if that only really helps for speed more than anything, it doesn't add a mountain of time, but
Sure.
it might add a week to the process.
How about industry wise?
We're pretty agnostic. I tend to view commercial construction companies specifically, I guess it depends on what kind of construction you're doing, but where I've seen a lot of companies struggle in the past is someone buying a commercial construction business where there's retention and progress billing and not truly grasping that industry. You can look at a commercial construction business that has shockingly good, consistent EBITDA, and that thing could be almost out of business the next week. If you don't really understand the WIP, the backlog, kind of the cash conversion.
Cash flow. Yeah, the cash conversion.
Yeah, and and for that, it's even worse. It's truly kind of cash in, cash out, because there's a lot of upfront money. If you're on retention, you're not getting most of your profit until the project's done.
Done, yeah.
If you're doing a 3-week project, that's not too bad. If it's a 3-year project,
yeah,
you really just have to understand that cash cycle. It's one of the few industries, even though the SBA makes us do it, and even our bank would, I tend to focus less on historical cash flow and just go right to show me the WIP, show me the backlog. That's all.
Okay. Yeah, I tend to dissuade people from those businesses anyway.
Yeah,
just like
it's all in how they're
do
paid.
it.
honestly. Like I've done a lot of roofing businesses, for instance,
Yeah.
that are non-progress billing. It's just even commercial roofing. I go in, I redo this roof. It
Yeah.
takes me 3 weeks. I'm paid 60 days later. That's pretty manageable.
Yeah.
If it's, hey, I'm building a hospital and I'm the roofing person on the hospital and I come in at point A and I'm there till point D and I'm getting paid out at point Z,
Yeah.
it could be a train wreck from a cash flow perspective.
Yeah.
But other than that, we're fairly agnostic. I mean, we'll even do things like I'm looking at several restaurants right now, which a lot of banks frown upon. Um, Hotels we're pretty picky on. I don't know if this really a model for this group, but if it's a hotel, we're actually probably lending more to the individual on hotels than we are to the actual hotel, meaning you should
Okay.
have a pretty strong PFS.
Okay.
Most people also, if they're not in that field today, you really should be running these businesses. And I know me personally, I would not want to run a hotel myself if I was buying a business. So we don't tend to see a ton of them either way, but otherwise we're pretty agnostic.
Okay. And you mentioned something around defaults going up last year. Do you have any information? What does the industry say is the reason?
Yeah, this is more speculative than anything for me, but
Sure.
I think part of it is during COVID, they got rid of guarantee fees and they juiced the guarantee to 90%. The premise behind that, it enticed banks to take a little more risk. For those that don't know the way that this process works, the SBA in the 7A program acts almost as an insurance policy against the bank's loss. So if we do everything correct and we have a deal for a while and then for some reason it goes bad and we lose $1 million, we send in a claim to the SBA, and in theory they write us a check for 750,000 or 75% of our loss. That's what allows us to do under collateralized deals, stretching out amortizations, et cetera. So whenever the economy seems to kind of be in the skid, that's a pretty easy way to kind of juice banks to do a little more work, is to say, hey, your 75% goes to 90. So your risk profile just went down. As long as you document it correctly. I don't know that I think that's a smart thing, quite honestly, because I think that's one reason we're seeing some of these effects, the default rate up because people took more risk. The other thing I think they kind of changed a lot of things over a short period of time. Back in 2018, I remember it used to be on an acquisition, the bank could only lend 75%. And the remaining 25 had to either be equity, seller note, or a combination of those two. And the seller note had defined terms. It had to be 2 years full standby, then match the SBA's amortization or the bank's amortization. For some reason in 2018, they said 10%, well, that's all that matters now. I have no idea why. So that was a fairly seismic shift back then. And what you tend to find is people tend to, and this isn't necessarily the SBA's fault, but they make a rule and they put it into 12 pages of legalese, and you start to see banks going, well, that says that on page 3. I think we can apply that to here. And then you start to see people taking more liberties with what hopefully was a simplistic rule, but then created more of a train wreck. Those are opinions. That I don't have any facts to back that, but I think you had that combination of pretty big swings in what the rules were. Higher guarantee allowed banks to take a bigger risk and still feel like they were covered. And then they also did a lot of things with, non-bank lenders kind of came into the space a little more. They're not regulated the same way banks are, so there's a little bit more risk appetite. It kind of comes part of the risk profile for every bank is some of these are going to go bad.
Yeah.
And if you look at that just purely from a business perspective, you can kind of map out that even if a bunch of these go bad, we're going to make money. If you don't care that there's a person there that's going in bankruptcy and default because you weren't conservative, it's pretty easy to grow your way out of a lot of problems as an SBA lender. You just have to stay ahead of the game. If you have this much going bad, but you do this many new loans, if you don't care about the person, you can make money doing this. That's probably not fair for me to generalize so much, but I think there were some lenders that used that model a little more liberally than a traditional bank would. No, I have no basis for that though, other than my.
Okay. It's not public. It's not public. The information about defaults per bank is
Um,
not. It
oh,
should
they
be
do it by
public.
bank. Yeah, you can
Yeah.
see it by bank, but
Yeah.
I've never dove into the details on
Yeah.
it. Um,
It's interesting.
it is.
Okay. Okay. So tell us a little bit about the guideline changes.
Yeah, so they made a pretty big sweeping change. The one that came in before this new SOP even, and this affects a lot of people buying businesses if you're raising capital. Everybody in the ownership team has to be a US citizen or a permanent resident green card holder. I've looked at a lot of deals over the years where there might be 4 or 5 individuals who invest in a business to help an entrepreneur get it going, and somebody's from Canada or somebody's from China or Mexico or whatever it may be. They may even be in the U.S. and have a non-permanent resident status to be here legally. They're not allowed to be owners of that business anymore. So that was a pretty big change to not have. They didn't give us any warning either. At least some of this stuff, they usually when they give pretty sweeping changes, they say, "Hey, here's the rule. It's going to take effect in October." This was Thursday, they told us, and it was in effect Friday morning. So if you have investors, you have to make sure, do a little bit more vetting to make sure that they are U.S. citizens, or like I said, permanent green card holders. Other than that, the biggest change in terms of business acquisitions was, I think it was 2 years ago, they allowed you to buy part of a business. It always used to have to be for forever.
Yeah.
That you had to buy 100% of the business. No questions asked. That created a lot of problems if you had an individual who owned the business who was 70 and retiring, but he or she only owned 87% and the other 13 was owned by key employees who don't want to retire. So the old rules, you had to buy everybody out and they all had to be gone. So I think part of that was, let's entice these owners to give people ownership in the business so that when they sell it, they can stay in and stay owners. So, but what that ended up doing was you had a lot of people coming in and saying, I'm going to buy 80%, I'm going to buy 75%, the seller's going to roll equity. And that's allowed still technically, but they changed the rule that seller now has to personally guarantee the loan for the first 2 years.
Yeah.
Honestly, we asked this question and we got 2 different answers, so I'm not confident in saying it. I don't understand still yet if all the personal guarantee rules apply, including pledging houses. I'll give it into a second, there's a credit elsewhere test, and we got kind of conflicting answers on that. But it typically has become a fairly moot point because I don't know why someone would personally guarantee a loan for a business they just sold to that person, unless it's like their kid or something like that. I could see that happening. But so I think buying part of a business or even the majority of a business, but rolling equity probably is gone. I didn't do a ton of that anyways. I always felt like owners staying around didn't help the buyer very much as people thought it would, because if they're still coming in every day and there's no clear defined exit that they're currently, that used to be 12 months, that the staff doesn't tend to view that buyer as the owner still. They still look to the old person all the time. The one area that did help and did come into play, and now we'll kind of throw in flux, there's certain industries, specifically in the trades, that you have to have master license technicians or master licenses for, electricians, HVAC, plumbing. Even though those, in my opinion, and it varies state to state, but even though those designations don't necessarily mean that much, it's just a guy checking the box at the end. Very few times do buyers have that, and so that's the ripple effect I see coming from this, is those are going to be tougher to sell.
Yeah.
You're going to have to sell to somebody who's in the field today. Or I also could see banks starting to go, okay, we're going to be a little bit more liberal with relying on that seller and their license as I go forward, just because we kind of got used to being able to do those again. But
So you
that's
think
the biggest.
banks will allow it?
Yeah, I candidly don't know the rule inside and out yet, because I just have to read through the SOP is a behemoth of a document. It's a lot of boring legalese. So
Yeah.
the old rule was, prior to 2 years ago, you could not rely on the seller. That gave them control of the business effectively was the reasoning behind it.
Okay.
With a lot of government items, it wasn't really clearly defined. You could argue one way or the other. Some banks took a more aggressive approach and said that license isn't him controlling it because you could just go to somebody else.
Yeah.
Other banks took it and said, no, you're telling us as part of your business plan the seller needs to be involved. What if he or she decides to say, hey, now I know I told you it's gonna be $500, now I want $100,000 to use my license, or go a step further and say that person dies, gets hit by a bus, whatever it may be. How do you keep your business going? So I think you might find some banks maybe get a little more liberal with, all right, tell us how you're going to do this. I did a deal a while back, probably 5 years ago now, where it's an electrical contracting business. He did not have a license, but he mapped it out for us. He said, look, I used to run a solar business for a team. We had 50 licenses under it. I could hire a guy tomorrow. The reason you don't keep these guys on is they're expensive, but they're not necessarily in short supply, but they're expensive to keep on. So you just have to find somebody else. And at a minimum, you can sub that out to your competitors and lose half of your profit. But you can maintain business till you're back up. But I think that needs to be vetted first. That was something none of us ever did. And all of a sudden we we can do this. And then they took it away again. And so now I don't think people really know what ramification there will be on that. That's probably the biggest as it relates to business acquisitions.
Yeah.
It's just that the ability, it was almost like they teased us for 2 years with being able to roll equity, and then they took it right back without actually just saying we don't want to do this.
Yeah.
So that one will be tough to vet out. You might see this come into play a bit too. It's relevant for a deal I'm working on that I'm about to close on actually. If those of you aren't familiar on the call, there's two types of SBA lenders. There's preferred lenders, and then there's everybody else who does what's called general processing. A preferred lender is given that designation by the SBA. We've done enough deals over time that they basically, it's more legalese than this, but you guys know what you're doing. We trust you understand the SOP. We're going to give you the authority to do these on your behalf. If you're just a traditional bank doing an SBA loan here and there, you have to go through the whole process at your bank and then submit it to the SBA for underwriting, which takes a lot of time. And candidly, I'm curious how the cuts that were made at the SBA might impact that process. But if you have the only reason a bank like ours would ever use the SBA's general process if there was an eligibility issue, we'd send it in for their blessing. They cut that out, so you might find banks are quicker to say, sorry, we can't do this deal because of general processing isn't allowed. So that's one other area. I don't know if any people. Go ahead.
About the loan part, the loan being accounted as equity, the seller financing. I'm sorry, seller financing accounting as a.
Yeah, so they changed that back to sort of what it was a few years ago. The way I always describe this to people, the bank is allowed to lend up to 90% of the total project, assuming cash flow works. The other 10% is a combination of is one of the options. It's cash in from the buyer, or it's cash and seller note. Prior to the new SOP, you were allowed to get away with as little as 2.5% cash in. Some banks made the leap to almost do 100% financing. I never read that was allowed, but the SBA more codified the rule. It is 5% cash from the buyer, 5% seller financing, fully deferred for the life of the SBA loan. That was a change because they had reverted for some reason to it only being 2 years. It used to be on full standby for the life of the loan. They changed it and they reverted back. So a lot of these new rule changes, quite honestly, aren't that new. They've reverted back to previous rules. It's more, and candidly, I probably followed that a little bit closer. The way that interest rates are right now, doing a 90% deal is tough anyways, from a cash flow perspective.
Yeah.
So I didn't have that a ton, but that maybe was a way to entice sellers to take on seller notes. Otherwise, is start to pay them a little more upfront, but they changed that back to fully deferred for the life of the loan.
Okay. So it's not just 2 years.
That's correct.
Okay.
Now I always caveat this with too. that's just the equity piece. If, for instance, you have a seller note of 10 or 20%, you can break that up into note A and note B. Note A
Okay.
is for 5% fully deferred. Note B is the remaining amount, and that's whatever you and the bank and the seller can kind of come up with that works for cash flow. It doesn't have to be the entirety of seller financing. It's just
Ah, okay. So it's not the whole, okay, that's a really good clarification. So it's
yeah.
just that equity piece.
Correct.
Got it.
Correct.
Got it. Okay. Well, that's good. Okay. Any other changes?
If you're an existing business owner today, you can still do 100% financing on expansions, which can include business acquisitions. There's some rules around that, but they restored. I don't know if many people on the forum here are into thinking of starting anything, but you technically could do 100% financing on startups. That is back to a 10% equity injection.
Okay.
I don't know if that was relevant for anybody or not, but other than that, I'm trying to think if there's anything real. There were a lot of changes that were like if you're doing a franchise, they used to have a franchise directory. You had to sort of be approved by the SBA. They got rid of that. That's kicked back in now. I think franchises have until July or August to be in there again, but you have to be an approved franchise to be able to do franchise, with the SBA as your backing.
And this is both startup and existing
That's
acquisition.
correct.
Okay.
Correct. Yep. Other than that, I mean, most of the stuff was they changed the size designations from what's a small loan to back down to 350. That doesn't really impact us. They reinstated that you do need life insurance. I don't know why they got rid of that, and I don't know how many banks followed
I think
that.
it was required. I haven't seen
They
any.
got rid of it, I think, for just the last year.
Okay.
So
I haven't seen any lender that didn't require it. Yeah.
I don't, and I think all of us, luckily, it wasn't in place for like 5 years. So I don't think a lot of people had time to think of it. There were certain instances, like if your collateral shortfall was fractional, you're doing a real estate loan and it's $1 million loan and the building at the normal advance rate was only $950. Well, as a bank, you might go, do I really care about the $50,000? I could see people doing that, but now you still have to get insurance for that amount. And they took that. The biggest change in terms of, I think part of the reason I make the argument, I guess, the part of the reason the default rate went up a little bit, they did this change a couple of years ago, I think it was, where they just called it do what you do. So they used to have all these rules codified of this is the SBA guidelines and how you do things. And then they basically said, hey, you banks do a lot of these. We're going to just change this rule. And they called it do what you do, which was effectively look at your loan policy and apply it to this. Depending on the bank, that could mean you could do all sorts of different things. Yeah. And they took that component back, which I believe is a good thing. A lot of people like to push the bounds on the SBA. You have your box, and then this little corner right here kind of bleeds into just outside of the box. And while that sounds great as a lender and as a borrower, when those start, just like everything, the person who took that corner and then went all the way over here kind of screws it up for everybody else. So they took away some of that creativity, maybe is the right word to use.
Flexibility.
That's right. Yeah. And then the big thing, which again, I don't know if it impacts everybody here. I guess it would in some respects. They reinstituted the guarantee fee.
Okay.
For all loans. So usually they try to waive the fees as an enticement for people, and they think it's banks, but it ends up being borrowers. So they had it where there used to be a fee waived up to $500,000. Then they did under $1 million, and between $1 million and $2 million, it was different. And then they went back down to just $1 million, and now they just said no. And if you look at, it was funny, the SBA did a big Zoom call for all lenders, and I was on it. They never lose money, the SBA, COVID being the exception year, but they really never lose money until last year. And they showed the fees that were waived, you probably would have made money still. The number of loans they did for under $1 million that had no fee was enough that they probably would have been in the black. So I think I think a lot of what they're doing right now and it was a little, whatever anybody's political affiliations are, it was probably more of a political call than I'm used to in the banking world, but it was very much a let's let's simplify this again. We started making all these rules to change this and do this and let the lenders, let's simplify this.
Interesting. But it kind of
So
restricts it. So it simplifies it, but it restricts it. So which is
correct.
kind of like anti, deregulation movement. So
Yeah, which is funny considering the
yeah,
difference of opinion there. But I think what they realized is there's, as much as they want to say they can trust the banks, they really shouldn't trust the banks.
makes
You know,
sense.
you can make the argument. I was in banking in '08. Banks and bankers are always going to say, what's the rule? I'm going to butt up to that rule and then I'm going to push it.
Yeah.
Not every bank, obviously, but
Yeah,
certain
yeah.
banks. And I think that's what you started to see was a lot of these loans, and there was nothing against it. I was as guilty. I won't even say guilty. I was effective as much as the next. Why on earth would I do a loan for $1,025,000 when I could do a loan for $990 and there's no guarantee fee?
Yeah.
I think you tend to view like these rules in black and white, and they tend
Yeah.
to not the real world of it. It's almost like every government in law. The intention was probably correct, but the implication of it created more problems than it solved in the
It's
end.
one of those things. Show me an incentive, I'll show you an outcome.
Absolutely,
Yeah,
absolutely.
so it makes sense. So now the guarantee fee, is that flat across all loans? Is that a one
No, it's
percentage?
tiered.
It's
So
still
it's
tiered.
yeah, it's
Okay, they
between
just
half
took
a
away the
million.
zero.
That's
So,
correct.
so it's like, okay, so it's
Yeah.
kind of silly, but okay. And then so technically the guarantee fee is essentially the insurance policy, and then that insurance policy covers for any losses for the SBA.
Yeah, the
If
losses
you're
in over.
saying the insurance fee covers the losses, and they can make money, so technically the insurance fee is the policy that
That's
you.
yeah. They never use that terminology. I do, but it effectively works that way.
Makes
Yes.
sense. Okay, now see, I didn't understand that before. Now I get it. Thank you.
Yep.
Okay, so as we're talking about, do you want to add something?
Nope. All good.
So I was talking about the regulation. So there was an announcement or a tweet by the SBA leader of the SBA. I can't remember, what do you call it? SBA commissioner, or what do you
Uh,
call that? Secretary, SBA
I
director?
should know that, shouldn't I? I just say head of the SBA. I don't
Head of
even.
the SBA. So there was a tweet about the fact that they were going to double the
Mhm.
limit for manufacturing.
Correct.
So can you
Yeah.
speak to that?
Yep. So that is for code. They do everything in the SBA world and government world by the NACIS code on the
Okay.
tax return. For those that
Yeah.
aren't familiar with that is there's a box on your tax return for a business. It's up near the name of the company and address and everything, and it has a code on it, and it'll specify a little bit of a description of what it is, but it's a physical 6-number code. If you're in those codes, which I believe is either 35 or 53, I could have one of those transposed, but you're in a manufacturing business, your guarantee can go up to $10 million, or your loan amount can go up to $10 million now.
And
The
that's
big
effective
problem,
already?
that's in place, yeah.
Oh, in place. Okay, good. What's
The
the big
big
problem?
problem with that, those codes are often wrong.
Hmm.
I'd say very often wrong. I don't think there's any tax implication to having a code incorrect. And then there's also things that sort of overlap, like are you a manufacturer or are you a distributor or are you a wholesaler? If you do all of those things, your accountant might just go, I don't know, they're a wholesaler, move on. That happens a lot too. I'd mentioned business acquisitions. You can do 100% financing as long as you're in the same geography
Yeah.
and the same 6-digit NACIS code.
Okay.
Those are often wrong.
Can it be
Even the same
changed?
thing. No, you'd have to go in and physically amend the tax returns. And even then, it's still, again, relatively new, so I've not pushed the envelope on that. But I think you'd kind of see that there'd be a lot of red flags that would get done. A lot of it, and just so you guys know how this works too, the SBA doesn't get involved in any deal of a preferred lender until it goes bad. They may come in and audit a file annually, but until you don't really know where you stand on any loan until you file that claim to get your money back. So you're a lot of times what you're doing, and I describe this to people often, is whether you want to do a deal or not, you typically know pretty quickly. It's within, in some instances, minutes or hours of looking at it. You go, all right, person's in that line of work, their cash flow is X. Here's what we're doing. It makes sense. You spend that underwriting time sort of playing defense against, all right, well, if it goes bad, what are they going to say? It's not usually presented this way, but that's what you tend to do is you're playing defense against a possible default not being honored. And because the SBA acts like any other insurance company, you file a claim, they go, well, we'll pay it, but you need to show us these 25 things. And if you only have 24 of them, we're not paying you the claim.
So most of the loan underwriting is not really a loan underwriting. It's mostly the insurance underwriting. That's what it is.
I think in this case you'd say they're the same thing.
Yeah.
You're looking at your policy, you're looking at the loan, and you're looking at what the SBA wants.
Makes sense.
And you make sure you document all this stuff. And that's what you're really doing, is doing a lot of documentation CYA.
Okay. So we'll open it to questions. Paul, you had a question?
So somebody had one in here earlier, I think.
It's Paul.
Yeah.
You want to say
was
Paul or?
Yeah, go ahead, Paul.
Yeah, I'm here. I'm having phone. Yeah. So, have you heard any chatter about the SBA expanding the $5 million limit to other NICS codes? And then B, does it still apply where if you have, say, one NICS code, you have $5 million, you hit that limit, can you say there's another NICS code, you can get another loan up to $5 million, so various NICS codes?
Yeah, so the answer to your first question is chatter, sure. Anything formal, no, on in terms of them allowing it for other industries. I wouldn't be, the way that this typically works is I wouldn't be surprised if they see how it goes. And if they start to see there were problems, they don't do anything else. If they start to say, hey, this actually worked, we're okay. There does become an argument, right or wrong, too. I know this is brought up a lot, is a $10 million business really a small business? There's a part of that, and should the taxpayers be subsidizing what, a $10 million business likely means that was a, probably somewhere between a $1.5 to a $3 million EBITDA company. You're probably financing the acquisition of somebody who's doing really well for themselves already. Not right or wrong, but I know that's some of the pushback that you see on this stuff.
Yeah.
But I don't, no one knows at this point, because it's literally just taking effect, so I don't even know if they know the impacts, much less what's going to be next. I am looking this up, sorry here. I think it is, okay, so the NACES codes that are eligible are in the 30s. It's 31, 32, or 33 is the first two numbers of that code. So those would be designated manufacturing NACES codes. There would be four numbers after that. So it breaks it down. The further you get into the code, the more detail it is. So it might be manufacturing. The middle section might be food manufacturing. The third part might be the specific type. But if you're in codes 31, 32, or 33, you're eligible for up to $10 million of loan amount. The other question that was just asked there, which has always been an ongoing discussion, specifically amongst lenders, the way that the wording it is right now is that you have $5 million per guaranteed individual to lend with your SBA money. So if you buy a business, your spouse has to guarantee it. You're both kind of on, that's your allocation amount. So if that was a $4 million loan, in theory, you used up most of your guarantee. They changed the wording a little bit to where it allows, I think, kind of what I said about best intentions, but the results maybe end up different. I think what they were seeing and why this was brought up is you might have a husband and wife, and the husband buys a manufacturing business, and we have to take the house, so the wife has to sign a personal guarantee too. And all of a sudden she goes, you know what, I really want to buy this accounting firm. I'm an accountant. And she doesn't have access. She doesn't have $5 million. She just used up $4 million in the company she's not even buying. And these are, again, my opinions. This wasn't said as the rule. But so what they said is you're allowed to buy businesses in other NACES codes that are sort of unrelated. And I think it was because of that. The spousal guarantee limited the spouse's ability to go do his or her other line of work. But to the point that was just asked, what it really kind of reads as is, well, if you buy a manufacturing business, and then you want to go buy an accounting firm, you can. I have not seen anyone test this yet. It's been well over a year that it's been in there. And every time I ask another lender about it, no one says they've done it. I'm sure there are people who have, don't get me wrong. But I think the bigger question that you have as a lender is back to the point of not can I do this, but should I do this, is how do you manage two sizable businesses like that? If you can prove very definitively that you can, you probably have access to it. I don't think you'd find universal answers on this, though. I think you'd find, I'll take, for instance, our bank. I think we would probably be more conservative on that. The husband-wife doing something, we'd probably be able to push. The individual who buys a business and has a $5 million debt and takes on another one, unrelated, as counterintuitive as it sounds, that's worse, because you'd think, hey, if you bought another manufacturer, which in this case, I guess manufacturing is a bad example because you can go up, but if you bought a distribution business and then bought another one to build that business, that's what you should want as a bank, versus I bought a distribution company and I bought an accounting firm. Two different things that require two different skill sets and full-time job on both.
Well, there are
I didn't actually answer your question there, did I? I just danced around for about 2 minutes.
I hear you.
There are businesses that are kind of cohesive, if you will, HVAC and plumbing or electrical, or, if you have an architectural firm and a development, business. So those kind of like they're leveraging the same client list. They're leveraging the same.
And that's, I think, where you'd run into a worse. I think they have to be even further separated than that. That's the point. Like, you can't be both in construction related. It's got to be, you're a restaurant and you're an excavation business, or it has to be. The way that I read it, they have to really be completely independent of one another, no overlap. You mentioned,
Colin, you mentioned going into that 10 million. Like, if you bought a manufacturing business and did 4 million, then you think that it'd be reasonable to do another manufacturing business up to a 10 million guarantee, even if it's two different businesses?
I think so. I mean, that the biggest risk you have in business acquisitions is the ownership transfer. Does the skill set keep going? Expansion lending is always going to be viewed very differently than a business acquisition. And what you're describing, Michael, is an expansion of your current business.
Sure.
It's kind of like a partner buyout. The risk of transfer isn't there. You have somebody in the business running it today saying, I know what my partner does. I know they're not going to be here, and I know I can replace them with my office manager. Yes, it would be a more attractive loan, I think, to most banks to say, I bought a business. Now, the second part of your question that'll come up probably, how fast?
Yeah.
There's no answer to that. It's how firmly you can say you grasp that business. It's going to look better if you bought something 3 years ago,
right,
and you're buying it today, than if you bought it 3 months ago and you're trying to buy something.
Yeah.
But I think that you show history of, you understand the business. Now we're just growing it through acquisitions.
Yeah.
And that doesn't have to be the 10 million number. We do that often, actually, where someone buys a business and then they buy out a competitor a year and a half later, and maybe they buy
through SBA or through traditional. Okay.
Yeah. Historically, too, that SBA. One question that might come up on this, if it doesn't, most people ask me when I do an SBA loan and I tell them about the personal guarantee, they immediately go, how fast can I get out of my personal guarantee? If you own a small business, whether you're doing an SBA loan or a conventional loan, you're most likely going to have to guarantee that loan. The risk is less in non-SBA because you're doing stuff with collateral. So you're buying a building, or you're buying equipment or a line of credit. So if something goes haywire, you can just sell that stuff and get it paid off. But personal guarantees are required on almost every small business loan in this country, SBA or conventional. Don't take my word for it. You can talk to other people. But if you're not behind that loan as a guarantor, there is no company. There's the old adage of, I gave the bank the keys, I couldn't make it work. What's the first thing you would do if you heard bank owned? I can get it at a 30% discount. That's what I would do. So what you're looking for in the personal guarantee is traditionally going to be, we're going to lose money if we have to take it. So you sell it for value. That's kind of what you're looking for with that. But anyway, so I went off on a bit of a tangent there, but you're going to see that that's a more attractive move, is to tack on, somebody who buys a business for 800K, then buys another one for 700K. I've done 5 loans for one guy that has done that over the course of the last 8 years.
Yeah, I got to check some NACES codes.
Yeah, to your
Thank
point, so the rules on 100% financing for business acquisition, same geography, which can be a little bit, there's some gray area with that.
Mhm.
6-digit NACES code. I should know this off the top of my head, but they changed it twice, so I'd have to look it up. I believe it still has to be a stock purchase, because you aren't really buying the assets of the business. You're incorporating that business into yours to be considered an expansion.
Yeah.
So you have to take over the stock and absorb it. And then you have to have the same management team. And by that, I mean, if you're the CEO today and you have a CFO or an office manager, you can't say, well, I'm going to need a separate, whether you do in reality or whether you do on your business plan, you have to be able to say, essentially, I'm absorbing this business into my own. It's an expansion of my current business. It's not me buying something else.
Got it. That's helpful. Thank you.
Why is the management thing again? I didn't understand it.
So you have to have identical management, and I think management isn't as defined as you'd want it to be. You could have an office manager at the other location, but you can't be going into it saying, I need to hire another CFO or CEO to run that location. Because what you're arguing in an expansion loan, and this is only if you want 100% financing. If you're putting 10% down.
So when we say the same management, it's for the acquired entity. Essentially, you're going to keep everything the same. You're not going to be.
No, the acquiring entity has to be able to absorb management abilities or requirements of the company being acquired. So you can keep all the staff in place. You can keep an office manager and AP person, but you can't say, I really need to hire a CFO to run this location for me, or a CEO to run this location. It's considered an expansion loan of your existing business, not an acquisition. If you have to keep more defined staff in place, senior staff, you put down 10% and then it's just an acquisition. But to be considered 100% financing, it has to be an expansion of your existing operation.
So that means you have to lay off the existing C-suite, whatever, if there's a CFO in there.
It'd be surprising to me if there was an official C-suite. Your kind of top line, you'd probably argue, as like a controller might be there.
Okay.
I don't think you'd probably end up having to. You could absorb that controller within. Some of this is nuance, and some of it's reality.
Yeah, no, I'm just fascinated. I'm just curious, like how they kind of think about it. But yeah,
it'd be unlikely to buy a small business. I guess not impossible, but it'd be unlikely to buy a small business where there's a CEO, a CFO, and a
CEO.
COO.
Well, COO, if you see that. Yeah.
Yeah.
Okay.
But in most of those instances, you'd have to ask this question of, well, if they want to stay around that bad, then they just buy them out. That's the practice. But you could even probably make the argument of you're just going to absorb them within your operation. But how you dictate it in the business plan is important.
Makes sense. Okay.
So is the expansion loan under the same terms? Like if you SBA 7(a) loan, like it could be an acquisition and or expansion. So there's still $5 million limits.
That's correct.
Or is there? Okay.
Yeah, you're still live within the $5 million confine. So if you bought a business for $2 million, or you had a $2 million loan against it, and a year later you buy another business, you've still got $3 million of dry powder in the SBA. And if you're an existing business owner, the rules are more defined as you're specifically buying a business. But if you're just an existing business owner who's doing something else, you're buying a building, you're buying equipment, you're opening a new location, whatever it may be, that's pretty easy to qualify for 100% financing on. There aren't as many specific rules around that. The acquisition has the rules because you're absorbing an operation, but if you're expanding your existing business, that's pretty easy to qualify for 100% financing.
Any new trends that you're seeing right now in terms of the deal flow, the deals that you're seeing, what's happening with the economy? Are we
Yeah.
past? Yeah, good.
So I think the biggest change that impacted general SBA lending, this is almost non-existent in acquisitions. I don't know if everybody's familiar with the term MCA loans. They're merchant cash advances.
Okay.
And effectively, I used to see them a long time ago that a restaurant would use them. So effectively what they do is they borrow against their weekend's credit card receipts to pay for their inventory. They'd have their normal weekend, they'd pay it off on Monday. Hopefully they don't need to keep that cycle much, but when you had a short-term cash, they'd basically say, all right, your credit card receipt average is this. We're going to lend you this. We know you're going to pay us back. We're going to charge you an exorbitant interest rate to do it. It's like short-term bridge financing.
Yeah.
Somewhere over the last couple of years, that went from what I just described to any business can get these loans if you can prove revenue. And they don't, the way it would work is you'd say you're a $1.2 million business, so you're $100,000 a month of revenue. We'll give you a $100,000 loan. It shows up as a $140,000 loan. So whether you pay us back over the next year, which we pull money out of your checking account every week, or you pay us off the next week, you owe us 140 grand. I don't know if 40 is the right number, but that's how it worked. So what you found was you had a lot of people. I didn't see requests for these loans 2 years ago. Over the last year, I was probably getting about once to sometimes 3 times a week somebody calling asking to refinance MCA loans. It became a very common loan. And like a lot of things, I think it had a good, it's kind of like subprime lending and mortgages back in the day. When done the way it was originally probably designed to do, it actually filled the void, but it was done 99 out of 100 times a different way. So they killed the ability to refinance MCA loans. That was kind of the biggest shift. That doesn't impact a lot of larger businesses, but that industry was booming with people doing these types of loans. And I think what the SBA, if I was seeing that level of volume, the SBA was probably seeing just hundreds, if not thousands a week and going, what the hell are these things? Where are these? And I'm pretty confident you would have seen a community of certain types of brokers who would have gone, hey, do this loan.
Yeah.
I'll get you the cash quick.
And I'll refi
Talk to this SBA lender and they'll refinance it and
Yeah.
become the taxpayer's risk, not mine.
Yeah.
That wasn't stated, but I think that's the way that'll be a pretty interesting thing to see shake out, because that kicked in June 1. So if you didn't have the loan approved and in closing and have an authorization number by June 1, it's no longer eligible.
Interesting.
Generally, I feel like just this is anecdotal, no backing for this. If you're familiar with the pari passu loan,
Yeah.
where
You can explain. You can explain it.
Yeah. So a pari passu loan is often used to get above the $5 million cap, and what it simplistically, pari passu, I believe, means side by side. You could do a loan for $5 million through the SBA and a conventional loan, typically lower, say $2.5, $3 million. You're buying a business for 10. You put down $1 million, you get $1 million seller note. You have a $5 million SBA and a $3 million pari passu loan. That pari passu loan is a conventional loan that the bank keeps on its balance sheet. It became very common in a lot of the search fund space and a lot of it's difficult to finance a business for an acquisition, especially with limited collateral, between about $1.5 million and probably about $5 million of EBITDA. Once you get above 5, you can get conventional leverage. Below $1.5 million, you're typically under the cap, but there's definitely a donut hole in lending there for how to bridge that size difference. And pari passu loans were doing that. I have seen a lot of lenders pull back on that, though. I'm going to guess they took some hits, or the capital allocation requirements went up or something like that. So I believe it's going to be more difficult outside of manufacturing now. I think you're going to see it's more difficult to finance a $7 or $8 million up to $10 million purchase. Again, opinion.
Yeah.
Not a rule by any
So there
means.
wasn't like anything written about the pari passu. Okay. That's
I
fascinating.
I think, like I said to begin with in this, that the pari passu loan makes a lot of sense in certain industries. Like you take daycares, for instance. If you buy a daycare, that business might only be worth $1 million, but the building's worth 5.5.
Yeah.
So how do you finance that? Well, you look at it as a bank and you go, well, wait a minute, we're secured by a $5.5 million building, and we're lending, $5.8 million. Let's do the 5 million with the SBA, the 800,000 in a liquidation scenario. What that benefit is for the lender is you sell the building, you pay off dollar for dollar. It's not a second mortgage, it's an equal mortgage. So you actually get out of that pari passu, and then the guarantee covers the remainder after that. But lenders started to view this and go, wait a minute, they didn't word it that it has to be secured by real estate. We've got a really strong cash flowing loan. Let's do it pari passu on acquisitions. And I every time that happens, what happens is there's a little bit of success. Other people start to emulate it, and then people start getting more aggressive, right? And so I think you saw that people were taking more risks on those loans. I feel like that has pulled back some. The investor thing, if you're a business buyer, the investor, so I should have told you this earlier too, but in addition to the no longer having investors from outside the US, you also now, if you have investors, cannot pay them a preferred return until the SBA loan is paid off. In full disclosure, I thought that rule was in place already because I had said it many times over the years. But I guess it's part of the bounce back between how different banks interpret rules. But right now, I believe that's going to heavily impact search funds that are raising capital for their down payment. And if you're a buyer who's competing against that they're not going to be as attractive to investors as they used to be. If you're following the rules, and that's a big if by some people, the way that this is worded now is if you invest money in a business, you cannot require, it's more legal than this, but you cannot require a preferred return on top of that. You are just an owner of that business. So you can take pro rata distributions like you would, but a lot of people were coming in more professional money and going, I'll invest $1 million in this business. I need a 10% clip every year until I get paid back, and then I get X and Y. And the SBA has never liked that, and have constantly, pre-COVID, they were already moving towards some changes. I remember the conference was at right before COVID. They were already talking about this. I think everything with COVID and PPP loans took up their time for 3 years, and now they're reverting back. They don't like professional money. They don't say this, but I don't believe they like professional money being in SBA. The contributors to a business are supposed to be family and friends. This is small business. They want it to be your mom and dad or your brother and sister or whoever or friend putting 50 grand in and going, hey, Jay, I'm invested in your success. Pay me back when this works, but it's your business to run. Professional investors looking for a return are never quiet. They could tell you they are. They could tell you that, hey, I just really want to support you. The second you don't hit your 10% return, there you go. Well, I've got my attorney working on page 43 of our document.
You got covenants in those
That's
operating
right.
agreements. That.
So I think,
yeah.
John,
John, you had a question?
What about like construction holes? Like if you need more than what, because you want to make an improvement to the business afterwards, so you want to do something above and beyond, but you don't need it all at the day of closing. Is that like a draw period?
Like as in you bought the business and then you needed funds for something else later? Is that what, am I understanding that correctly? Yeah, I mean, you do it as two separate loans then, depending on how, so it depends on when and what you're doing. A lot of loans, for instance, that we're doing, especially as people buy a business that includes real estate and they have $500,000 of improvements they need to do to the property. You close on that loan and then you do a draw period. You follow the guidelines. I mean, you say I needed $500,000 for X, Y, and Z. You follow X, Y, and Z, disperse the money accordingly, and then term it out. If you said, hey, I bought a business on June 2nd, got in there, and then realized, oh, I really need $500,000 to do something else, you're looking at a second loan. Did I answer that?
Yeah, I think so.
Okay.
Yep.
I would
How
say
often-
probably half of our loans nowadays are done what's called multiple dispersing. So traditionally, a business acquisition or real estate, you fund it, close, wire goes out, you're done. But a lot of deals nowadays we're seeing, even with the SBA has gotten a little stricter on working capital without actually telling us they got stricter. So they want us to follow the funds, like where you used to say, hey, I'm buying a business, it's $2 million. I need $200,000 of working capital. Sure, no problem. Loan total deal is 2.2. They want us to be a little more detailed now. So we're probably going to go, okay, at close, we're going to do the 2, but the $200,000 you have to show what you're using it for, receipts. You do like a little bit of a draw period on it. I don't know if every bank does it that way, but we've been doing that to do a little bit more of the CYA work. I told you, is to say, if something goes haywire, we can go, hey, said they needed it. We gave it to them. We documented that the money went to that place. Please pay us our guarantee back. But you can do that, John. There's no restriction on. I don't know that maybe there is a number that I don't know it, but you can do as many SBA loans as you want. The $5 million cap is the relevant piece, not the number of loans that got there. So if you had one loan a year for the next 5 years to buy equipment, you're fine doing that. There's nothing that prevents you from doing more loans later. What could prevent you, just full disclosure, is the current bank that did your acquisition loan or whatever the first loan was, is in first position on all assets. So if that lender said no, you're going to have to go probably a different route to finance something later, because there will be no asset coverage if you do that. If that didn't make sense, I got 2 blank looks I saw on that, but you want to make sure you're working with someone who can not. I tell people this all the time. The doing the loan isn't really the hard part. It's, did you do it correctly that set that person up for working in an efficient way later? And if a lot of people are just so hyper focused on a close that they don't pay attention to, well, what happens in a year and a half if I need X, Y, or Z? Nobody in my role can definitively tell you what the bank will do at that point. But you get a feel for someone of saying, hey, you're at risk. I wouldn't, you're probably not going to get it. If you tell me you need working capital 8 months after you buy a business, I'm going to probably tell you that you're not going to get it. That's not how these, you have to really do your diligence up front on working capital. People usually won't tell you that at the time, but I push way harder on working capital than I do on cash flow. Cash flow is pretty easy. It's this over this equals this. Working capital, the hardest part you have as a buyer of a business is you're likely buying a debt-free, cash-heavy business, and you're replacing it with a debt-heavy, cash-free, or cash-light business. Better way to say it, current owner can be very inefficient and be fine, because they've earned that over the course of the last, 15 years of no real recessions, depending on what happened in COVID. You're taking on a business that you have to be hyper efficient, because you're going to have leverage with less working capital. So most people, and the SBA never addresses this stuff in the SOP very clearly. So most lenders don't look at it. They say your cash flow is this, you have industry experience, I can get you that loan. Very rarely do you say, well, wait a minute, how long is the cash conversion cycle? You have 40 days until you're going to receive any money. Do you have the ability to cover not your loan payment, which is what banks care about, but your payroll, your electric bill? You can't accrue those things. You actually have to pay them. And that's the mistake most people make, is they do an accrual look on a business acquisition, and they neglect to look at their actual bank statements of the cash in, cash out that has to happen for this to function.
Michael, you had a question?
Well, yeah, I was interested. What do you think about if someone over equitizes up front, and then with the idea, like I'm looking at a deal right now, like where I may, it's a small deal, but I think there's a lot of growth potential. And there's an aspect where I'm thinking, like, if I can pay it all cash up front, it gives me a lot more flexibility for everything that we're just talking about.
Yeah.
And then I can get in and I can figure out a little bit more, like, what levers I want to pull for expansion, and then attack there. But I guess I was worried, like, do I miss out on, you know, the
Funds.
the funds or the SBA
Yeah.
reality by doing it in that order of operations?
Yeah, I mean, the surest way to tell you it would be put your leverage on at close because it's there and you can always pay it off. That's also the most time prohibitive. Being quick with your own cash might mean you can get a discount on the buy.
Yeah.
Depending on what you're looking for later, and size is relevant too. There's a lot of lenders who won't do anything in an that are acquisition lenders who won't touch a deal below $1 million.
Mhm.
So if you say, hey, I paid 700,000, making up numbers, but I paid $500,000 for this business with cash. Now I need 300 to grow it. The pool of lenders went from here down to this. That's where
But as you get larger, if you pay $3 million in cash and you're like, now I need 1.5 to grow it,
yeah, then
then you maybe got some access.
It's typically going to still be a different lender because the truly aggressive acquisition lenders, this is a little bit more of a broad statement, but tend to not be as effective in the other areas. It was actually candidly my biggest learning tool when I came over here 2.5 years ago. I was pretty much a one-trick pony at my old bank. I was an acquisition lender. That I think I looked this up, 95% of what I did at that bank was just acquisition loans. And then accompanying lines of credit that went with it, and we did banking services. But we didn't do real estate, we didn't do startups. I don't think if it was a franchise, it was just an acquisition. We didn't even really review the franchise that much. So what I learned was that, and I competed against those banks like that. And then as I've come over here and been more kind of holistic in SBA lending and doing a lot of different things, I realized I don't see those banks as much as I used to. So I think you find that banks silo a little bit. There are specific banks who only do real estate, for instance. There's specific banks who only do business acquisitions and others who only do franchise. You might find your people you're talking to are different when you're looking at buying something versus when you're looking to expand. Not bad, or that doesn't necessarily mean it's the right move, the wrong move, but it's just a unique flair to it.
Yeah, that's helpful.
Can you do a cash out equity loan on the business like that?
No, you have to have a pretty defined source or use of proceeds.
Got it.
So
it has to be an expansion loan.
Yeah, it has to be expansion. Or there are some rules you can play around with. Like for instance, I did this loan one time. This was one of the few loans at my old bank I did that was not an acquisition. We did an AP refinance it was a roofing business, and so they were doing well, but they had gotten out of sorts a year or two before, and their provider, their supply house that they worked with, sort of floated them at a higher interest. And so they were poised for growth, but man, they were levered to the teeth. And it was, then they got huge discounts if they could pay that early. So by legal definition, a receivable or a payable or a contract, it's a due to, due from, it's like a note. Yeah. So it was eligible to refinance. So we paid all of their AP off, and it was pretty easy because it was one company they used, and refinanced that over 10 years. So that immediately jacked their, they got their margin or their volume. They got their, if you paid in less than 10 days, you got a kicker for that. And then they use credit cards to get an even bigger kicker. So it made sense to do in theory. I'm not saying you should or shouldn't do this, but in theory, there's ways to play around with, hey, I want to pull $800,000 out of this business for something.
Got it.
What if we just did a loan to pay off the AP? Yeah. I don't think we'd be the one to do it. You could do that, but it's not designed to benefit the owner financially.
So you did it 10 years. That means it was SBA.
Correct.
Oh, that's interesting. Okay.
Yeah.
Wow.
That was kind of like a
creative way to do it.
Not quite a needle in a stack of needles, but a needle in a haystack for sure. I wouldn't put that one on my calling card as it made sense. It was very unique. I probably looked at 30 deals over years that were in that same request mode that I've declined. That one was very specific to high growth, simple, one payable payout, and there was a very defined reason for it.
Nice. So for people that are pursuing the acquisition route, at what stage would you like them to reach out to you?
I typically tell people there's two ways to answer that question. If you've already got it under LOI and you've already vetted everything out and you just go, hey, here's a deal, I become a commodity at that point of some sorts. Every SBA lender is going to tout how great they are, how much better they are than the next. We all kind of do the same thing. We're in the same wheelhouse. You might get a different flair for people, but we follow the same SOP with some tweaks of how we interpret it. But if you already have everything under wraps completely, you sort of are commoditizing this a bit, which is nothing wrong with that by any means, but I'm not adding a whole lot to the conversation at that point. Where I can hopefully add something that makes me more valuable than just a quarter of a point in interest difference is you come to me early and you go, hey, everything has a uniqueness to it. I've got a problem on this one, or there's an issue. Mitigating that issue early in the process, specifically when you're in the negotiation phase, how creative you can get with things like seller notes or working capital, because most sellers of businesses typically are not as sophisticated financially. They're going to be somebody who started a business often or bought it 20 years ago, grew it, knows that business inside and out, and this is their first real slug of money that they're going to be getting. Setting things up. For instance, one thing I tell people nowadays, if when you have add backs, for instance, so the easiest thing you can underwrite is easy. That's provable. Then there's the other stuff, all that, anywhere from 1 to 50 add backs they want to add. And you believe in those add backs, but the bank isn't all that comfortable with them, or the SBA doesn't recognize it. Interest rates are not that attractive right now, but you can use that to your advantage to say, okay, seller, there's $400,000 of verifiable EBITDA, and there's $100,000 of other stuff. 20% of this is going to be done in a seller note that's contingent on financing or contingent on performance. But the good thing is interest rates are 10% right now. So I'm going to pay you 10%. We're going to do it over 3 years. I just covered your capital gain on that portion of it. Like, coming up with something creative like that is where this gets fun. If it's just, does it cash flow? Is it an industry? I'm more than happy to put a term sheet out, but I'm a bit player in that. So to answer your question, my preference would be to talk before an LOI, even if it's just to vet something that I see as possibly a problem. A lot of buyers will just send me their sim they're looking at and say, hey, I'm thinking of offering $2 million, 10% down, 10% seller note. What do you think? I'm not going to read it like a novel, but I'll go right to the relevant sections and go, hey, did you see this? Did you see this? Having managed the relationships with these businesses over time, I see a lot of things that maybe aren't in the sim, like roofing businesses. I did 4 of them in the past. They're very unique in where the rebate matters a lot and that rebate is only attained if you can pay up front for the inventory. If you can't, you're now leveraging, you need the terms, you just lost 2 to 4% margin that the current owner has. So I try to add some level of value in that aspect, but most of the time, you tend to be more of a sounding board. When you're looking to buy a business and you're doing it on your own, you sort of get caught in a vacuum, or a tunnel, whatever you want to call it, where the deals start to blend together and you start to go, wow, I liked this business and I liked this one, but I'll do this one. I feel like my job is to push back and say, do you really want to do this one, or are you doing it because you missed out on the things you liked? Or here's what I think you're going to run into as part of this. It helps if you can do that before you get the LOI, because then you got to go back and go, well, I'm sorry, I didn't realize this, and you're retrading it. So the goal I'd have is to try to give you some level of either knowledge or creativity that helps you win the LOI. If I get to that stage, I tend to believe I'm not going to lose a deal over a quarter point. If I'm just a commodity, I lose over a quarter. It's who's got the best rate, and that's it. If you're actually adding value to the deal, and I help you find a way to structure that deal that costs you less money out of pocket. For instance, I'll give you, I'm sort of monopolizing well over our time here.
No, go ahead.
Deal right now that I'm talking to someone about. And I'm one of many banks talking to this individual. And he had to raise some money to buy a business, and it comes with the real estate. So he's now going, well, now I have to raise more to buy the real estate. And I told him, or I asked him, like, well, how important is it to buy the real estate at close? The seller said he doesn't really care. He just wants it back. He wants to be out of everything within the next couple of years. So playing the rules of the SBA, you can buy the business today only, do a lease to own situation, and buy the building later at 100% financing, because you are no longer buying a business, you are doing an expansion loan.
Hmm.
So in that case, that saves him having to come up with an extra couple $100,000 to buy the building that he can then do later himself without diluting his equity.
When you say
Stuff like
later,
that. Where this
when you
is
say
fun.
later, what is that? Is that a year, 2 years?
So we typically it's not defined what later
Okay.
is. So I
Okay.
typically tell people do 6 months at least.
Okay.
And you know,
That's
the
pretty good.
honest answer I will give you, very rarely are these ideas done. They're implemented.
Interesting.
But they give someone an upper leg when they're talking to the seller.
Yeah.
You know, like that's what your real, in the end of the day, it probably ends up looking a lot like a normal deal. But then the other angle that I just gave him, that same guy, the same discussion. I don't do 504 loans, but I can always partner with somebody who does. If you're not familiar, that's a SBA program specific for real estate and permanent equipment. They're much more flexible on down payment than the 7A. The seller can actually fund 100% of the seller note if you do it in a certain way, or of the equity.
Equity.
So I try to bring something to the table that's not just Rule 43, page 7 says this. It's more like, okay, here's what you want to accomplish. Here's what the seller wants to accomplish. Let's push and let's see if we can make that work. And it usually, the experience tends to be, it usually ends up looking fairly close to what the other people got. But you implanted an idea, you stood out from the other 7 buyers at that point. And even if you didn't do that deal, you still look different than everybody else.
Yeah, that makes sense. Okay. Well, I appreciate it, Colin. Thank you for
Sure.
taking the time today. Sorry for the technical difficulties up front.